Hello, this is Kevin Lynyak, Fixed Income Portfolio Manager at Parametric. Today is Monday, August 5th, and today's Fixed Income 5 will discuss what's been causing such large moves in the bond market recently. I think it was Lenin, and that's Vladimir, not John, who said there are decades where nothing happens, and there are weeks where decades happen. And it's not just in U.S. politics that we're referring to. A lot has happened in markets in the last few weeks. So I go back to July 16th when we were making new highs in stocks and credit was trading near multi-year highs. Now we've had a retracement of 8% in the S&P 500 from the highs in equities, and we've also had a large move in the bond market. So to put this move in context, the 10-year was 40 basis points lower last week. And not to be outdone by the 2-year note, which was 50 basis points lower. So the bond market has now retraced all of the losses from the beginning of the year and now trades at yields below where we started the year. Recall, we started the 2-year note was at 4.25%. It traded up to 5%, and it's currently at 3.88%. So pretty large moves. Part of this move started months ago as the result of inflows into bond funds as investors have been locking in yields. The yield pullback during the strong first quarter inflation and employment data gave bond investors another chance to allocate to yields at multi-year highs. And in many cases, investors missed the massive rally that we saw in fixed income in the fourth quarter. So they got another bite at the apple. Now we have gotten back to yields where we started the year at, and even lower in the front end as the market anticipates imminent rate cuts from the Federal Reserve. Last week's rally was a massive move driven by a smorgasbord of multiple things happening at once. It was weak employment data, recession fears, U.S. politics, geopolitics, fears about the Middle East, an unwind of levered yen carry trades, fully valued equity markets, especially in tech stocks. On top of that, you had Warren Buffett taking profits in some of his major stock holdings. So all of this during an illiquid market in August. So I don't think it's just one culprit. But volatility was low, complacency was high, and with so much going on, we were probably due for a pullback in risk markets. But this is why you are supposed to own high-quality fixed income in your asset allocation. Specifically to the bond market, soft economic data has the market thinking that we're in for a growth scare here and that the Fed is behind the curve. The first slide here is the Citi Economic Surprise Index. This chart reflects softer than expected data in employment and other areas such as manufacturing, construction, housing, and durable goods. But the market has been laser focused on the employment data, and I think it should be. The consumer is close to 70% of the economy. On Thursday, we saw unemployment claims jump to 249,000, the highest level of the year. Some of that was weather related. And continuing claims, though, have been slowly rising to levels that we last saw in November 2021. Jobless claims are a leading indicator of economic activity, and they've been trending higher over the last few months. There's something that I watch pretty closely. All right, so the rally in the bond market really accelerated on Friday after the soft unemployment report for July. Where we saw 114,000 jobs were created in July, below expectations of 175,000. But more importantly, the unemployment rate, which you can see on this next slide, rose to 4.3%. Expectations were 4.1%. And this triggered the SOM roll. So what is the SOM roll? Well, the SOM recession indicator has gotten a lot of talk recently. It signals that the start of a recession happens when the 3-month moving average on the national unemployment rate rises by 0.5 percentage point or more relative to its low during the previous 12 months. And the unemployment rate has been moving steadily higher, especially since the low that we saw in April 2023 of 3.4%. Now, Fed Chair Powell was asked about the SOM roll at last week's FOMC meeting. He characterized it as a statistical regularity, those are the words he used, and more than a hard and fast economic roll. And I would liken it to, I would agree with him, I would liken it to the inverted yield curve, which has been a tried and true recession indicator going back 60 years. But we've seen an inverted yield curve now for over 2 years and no recession yet. Let's touch quickly on the FOMC meeting, where we saw that the Fed left rates unchanged. I think that was expected, but prepared the markets for a September rate cut. Fed Chair Powell spoke to both concerns of the dual mandate being in balance, namely inflation and employment. And with the last 3 CPI prints coming in lower than expected, and the headline number for June coming in negative, the Fed feels confident that inflation is slowly moving down to their 2% target. So now with inflation in check, the Fed can now pay more attention to the employment markets, which have been coming in quite soft in the data recently. So I think if the Fed had the July employment data in their hands at the recent July 31st FOMC meeting, they would have gone ahead and cut rates 25 basis points. So we expect the Fed to cut rates by at least 25 basis points at the September 18th FOMC meeting, which feels like a lifetime away at the moment. Powell primed the markets for rate cuts at the next meeting. The question now is by how much? The market has 50 basis points of rate cuts priced in, with some now even calling for an intermeeting rate cut. I don't see that happening unless we have some form of liquidity issue pop up in fixed income markets or equities or foreign exchange. I just don't see that happening at the moment. We just haven't seen that kind of liquidity event. But the Fed remains on standby. Look, we have two more CPI reports and an August payrolls report before the next Fed meeting. I think you would need to see further deterioration in the data, like a sub 100,000 payrolls report or the unemployment rate ticking higher for the Fed to go 50 basis points in September. Recent Fed speakers in the last 24 hours have sounded calm and have warned not to overweight one data point like last Friday's payroll report, which could have been affected by weather like Hurricane Beryl hitting in the middle of July in Texas. So at this point, a lot is priced into the markets. Rates could continue to move lower if the data gets worse from here. But with the U.S. running deficits in the 6 versus 7% range, I have a hard time thinking that we're headed into a recession imminently. And these deficits will get funded as debt in the Treasury bond market. So this may cap where longer term rates can go in the near term. And not all of the recent economic data has been negative, I'd like to point out. We had stronger than expected ISM services data on Monday, and just 2 weeks ago, the second quarter GDP was reported at 2.8% versus expectations of 2%. And more recently, the Atlanta Fed GDP Now data has been tracking the third quarter, just 1 month down, at 2.5%. So I do expect the economic data to soften in the second half of the year and for the markets to get a little more volatile as we head into the fall, which is seasonally kind of difficult. And also we have U.S. elections ahead of us. But the pace of the weakening will decide the magnitude of Fed rate cuts. With short-term rates near 5.5%, the Fed is fairly restrictive and has a lot of dry powder to cut rates. 2 to 3 rate cuts in the risk management type, would help us avoid a hard landing. And this is a similar scenario that we saw back in 1995, where we did avoid a hard landing. Fed funds futures, though, right now, they're pricing in more than that. They're pricing in around 1.5% of rate cuts by the end of January. So this rate move looks overdone to me. Okay, that's a wrap. Please reach out to your local Eaton Vance distribution representative if you'd like a further discussion on fixed income. Good luck and thank you.